Hey everybody, this is Sean with Not Financial Advice. Welcome back to another episode. It's the middle of the trading day on Friday, May 3rd. And what we're going to be talking about today are 5 stocks that are down 40% or more. Now, I think all of these will do quite well over time. But as we go through these different investment opportunities, what I'm going to do is share with you which ones I think might have a greater prospect, be it in the short term or even in the long term. So stick with me, and I'm going to show you some of these amazing investment opportunities right after this.
You need to diversify your bonds.
The only problem you're going to have is that you didn't buy more. Because by the time you read about it in the Wall Street Journal, it's already too late.
All right, guys. In today's video, we're going to be covering Target, Starbucks, Estee Lauder, TAP, Molson Coors, as well as Dollar General. And the question that I have for you is this. Do you own any of these stocks? Have you owned them in the past? Are you looking at buying any of them? But I just want to get sort of your general feedback, not only on today's video, but also on these companies in particular. So if there's anything that you want to talk about, any thoughts that you want to share on any of these stocks, go ahead and leave that in the comment section below. Today, the S&P 500 is up 0.83. My portfolio is matching that performance, and I have some different stocks that are doing better than others within my portfolio. So what we can see is these top 5 stocks here, here, and here are outperforming up 3, 4, or 5%. And so it's a pretty mixed bag, with Apple leading the market higher, up nearly 7%. But then you can see some consumer discretionary names, as well as some communications and materials. So it's a pretty broad-based little baby rally in the market today. As far as what's not working out so hot this Friday, we can see these stocks here, and here. So we have Starbucks, which had a bad quarterly earnings report. And then we have Estee Lauder, so consumer discretionary, consumer defensive here with Seneca. We have SCI, which is a funeral home, down, and then we also have Coinbase down. These stocks down around 2.5%. So let's dive into the topic of today's video. I'm going to ask you to like it, subscribe to my channel, and let's get going. So first stock we want to talk about today is Target, which is down from all-time highs. At this point, just about 39%, a little bit over 39%. And, we can see that the stocks performed really well. In shorthand, in layman's terms, I can refer to it as a great investment because it's returned almost 110% in 5 years. Also because I think it's a strong company with a loyal fan base. So if we look at the stock over all time, we can see the trajectory that it's been on. You can draw a straight line from here to here and see that it wants to go up into the right. But there was times when it was most certainly overvalued in late 2021. And so now, just in the last 5 years, what we have is we have the peak, and then we've seen that the stock is down about 39%. And so, in this area, it's sort of consolidated from here to here. So for about 2 years, it's consolidated, and it's on a little bit of an uptrend here. And so overall, this looks potentially promising. Let's get over here to Qualtrim and take a look under the hood and see some of the metrics that help us understand whether Target can be a good investment. So right off the bat, this is a large cap stock, $73 billion. It has a reasonable forward PE of under 18, pretty in line with the market. You can see it has a healthy free cash flow yield of 4.9%. And looking at dividends, we're at a safe payout ratio. So it's less than 49% payout ratio, paying a healthy 2.8% dividend yield. So certainly a dividend name as well. Let's get into our different metrics here, starting with top line revenue growth. It's over 7% at this number, earning a thumbs up from me. Let's also take a look at the free cash flow and see how that's shaking out. So we can see, from say 2014 to 2024, we've got a jump from $3 billion in free cash flow to about $3.6 billion in free cash flow. So it's gone up and down. They had a rough period in 2022, going into 2023, but overall free cash flow is growing at nearly 9% over the last 5 years. A thumbs up. What other metrics are important to understand the prospects of this investment? Well, you have earnings per share growing at over 10% a year. That's a thumbs up for me there as well. And looking at cash and debt, let's look at the most recent quarterly numbers for that. Their cash and debt situation is improving. You can see they've had higher debt and less cash in the past, but they're moving back to that place where they're more comfortable, which is about 2/3 cash to a full value of debt. And so overall, this situation is improving and looks okay. I'll give it a thumbs up. And now what we'll do is switch back to the annual view, and we're going to get a sense of how the dividend payments on this stock look, with dividend growth rate at 11.4% per year over the last 5, 3xing inflation, protecting your money through dividend growth. And so it's a big thumbs up here on target with a dividend rating. Now, let's take a look at shares outstanding and see if they're diluting shareholders. They're not. Over the last 5 years, they've bought back shares at a clip of 2.8% a year. Big thumbs up for me here as well. Going into ratios, when we look on their returns on capital employed, it looks like it's held steady for a long, long time, right around 15%. And so this is slightly better than average. I'm going to give it a thumbs up, but we'll look at profit margin and see a little bit more of a mixed bag. It's sort of held in this 3 to 4% range, but it's holding steady. And so I'll give this a small thumbs up, but I think that it looks pretty okay. Much higher bottom line margins than a company like Walmart or Kroger's, as they sell discretionary goods. Now, lastly, taking a look at price to earnings ratio over the last 10 years, it looks as if they are, let's look over the last 5 years. It looks like they're trading historically at a discount. So a big thumbs up for me. And expenses are rising slightly. So that'll actually be the only thumbs down. But, I think this is the thesis on this is that women love shopping at Target and they control consumer spending. It's not really hard to understand. They've also done a good job with multi-channel, so you can do pickups, order online, etc. They also have exclusive brands with people like Taylor Swift. They have Starbucks and Ulta Beauty locations within their store. This is one I feel super strong about, and I'm eager to be able to add to this position while it's down nearly 40%. So like the video, subscribe to the channel. We're going to start going through the rest of our stocks. Next will be Starbucks, which is down about 41.5% over the last, say 3 years. So is this stock a good investment? Well, it's been essentially flat, consolidating for 5 years. You'll usually see that before a stock is going to make a big move, either upward or downward, and so that's kind of what we're guessing about. But we can see, even if we just go back to around the same time in 2014, we can see the stock has returned about 105% in 10 years. So around 10% capital appreciation per year, if my numbers aren't wrong. Enough of a reason to call it a great investment, but knowing that it would be potentially better to buy it today than to have bought it and waited for 5 years for it to do anything. So let's take a look at the different metrics for Starbucks. Large cap stock, 85 billion. Forward PE of 21, which is a little bit expensive. A nice, healthy free cash flow yield of 4.4%. And we're going to breeze through these. So the drill. Let's look at revenue. Top line revenue over the last 5 years, up 7.8%. Thumbs up. Free cash flow over the last 5 years is down, but over the last 10 years is up. So they've had a big year in the past, 2018. That's why the 5-year number is down, but 7.6% over the last 10 years. I'll give it a thumbs up for that, although this is slightly inconsistent. So a little bit of a concern. Now, looking at earnings per share over the last 5 years, they're flat. That can explain sort of its flat performance. But over the last 10, you can see huge earnings growth. A lot of the growth may be behind this company, and so it might be in the process of being re-rated. I'm going to give this sort of a neutral rating. But let's check in on the dividends here. So the payout ratio is a little bit higher than I'd like, nearly 62%, and it's at a healthy 3.04% payout ratio. So I think that, we're going to take a look at dividends in a second, but looking at cash and debt, um, overall, this looks okay to me. So I'll give it a small thumbs up. And looking at dividends, we've seen that historically they've grown at 16%, but that rate's slowing down to 9.6% over the last 5 years. Now that is 2 or 3xing inflation, but over the last 2 years and over the last 1 year, we're seeing the dividend growth starting to slow on this company. So it's a mature dividend paying stock. Keep that in mind, that there may not be a huge amount of dividend growth in front of the company. I have never seen a dividend cut from this company, but its payout ratio is a bit high, so you need to have some caution when buying this. Looking at shares outstanding over the last 5 years, they've bottomed down 3.8% a year, not diluting shareholders. Sign of a pretty mature company, thumbs up. Looking at returns on capital employed, let's just look from 2014 to today. So in the past, they've had returns on capital at 40%. It's now down to 30%, which is quite high, but the trend is not improving. So because it's so high, I will give it a thumbs up, but more signs that we're looking at a mature company that should be invested in that way. Looking at profit margin, I do really like the looks of this. Okay, bottom line profit margin, should be high for a company like this. Well, it's held steady over the last 10 years. It's at nearly 12 or so percent. And the trajectory over the long arc of time has been up. So I'll give it a thumbs up. It's good to see that they can hold their margin, but they may not be able to expand margins forever with inflationary pressure. So a maturing company. Let's also take a look at, we looked at all that. So now we're going to just jump to historic valuation. Let's go over 5 years. So it looks like it's trading at a historical discount, which I like to see as we're seeing this as a maturing company. Thumbs up for me, with expenses going up, which will be a thumbs down. So I'll ask you to like the video, subscribe to the channel, and let's see what else we can see for our next stock, down 64.4% over the last 2.5 or so years, is Estee Lauder. Is this a great company? Is this a great investment? So it's defensive. They have a lot of the best or strongest prestige beauty makeup lines across the world, not only in the US, but even to a larger extent internationally. And so makeup is defensive. I like that. The international exposure can be a double-edged sword, but as you see populations grow in places like India, they'll definitely look towards Western fashion. And so this is one that since 2014, it's returned around 10% a year, a little bit, about 9.4% a year, but you've not been rewarded over the last 5 as an investor. And so just over the last 2.5 years, we've had this big drawdown. Is there more to go lower than a 64% drawdown on what's been historically a good stock? Let's take a look here at Qualtrim. We have a note that Estee Lauder shares are trading higher, rebounding after dropping Wednesday on weak guidance. So weak guidance. Let's look annually. Forward PE of 34. So that's high. This one's traded traditionally pretty high, but it's higher than the market. So that's a little bit of a red flag at this point. Yeah, and we're seeing negative free cash flow. We do see a healthy dividend, 2%, but they're underwater on it. A massive payout ratio of over 148%. So I've got some concerns about this one. I do own it, but let's take a little bit of a deeper dive. Revenue growth over the last 5 years is barely keeping up with inflation, and it's declining from 10 years. I'm going to give it a thumbs down on top line revenue growth. So if we don't have top line revenue growth, I suppose that we need dividends. So dividends are paid with free cash flow, and we're having a lot of problems here. Negative free cash flow. Let's take a look under the hood on a little bit more of a granular level. Let's look over the last 5 years. So there's some seasonality to this. So we saw steep drops and declines here. It's recovering. So there's a little bit of a V shape here. But I'd be interested to see what it's going to do over the next few quarters. So just to keep this high level, their free cash flow has been flat before it's gone down. I'm going to give that a thumbs down, actually. So we're starting to see some of the reasons this is down 65%. But I don't think that they're going to not have free cash flow forever. So we just need to make sure this is cheap enough. Earnings per share growth of less than 1% over 10 years, thumbs down. Cash and debt, it looks okay. I'll give it a thumbs up. Dividend, they've cut before. Although it's grown at nearly 9% over the last 5 years, they're at an unsustainable payout ratio. And because they've cut before, I have to give this a thumbs down. A dividend cut might be the thing that brings this thing to the value it needs to be at. Looking at shares outstanding, they're doing a good job not diluting, I suppose, down about 0.8% year over year over the last 5. Actually, that'd be a thumbs up. Ratios, return on capital employed, it's moving in the wrong direction. Historically, they've been able to keep it around 20%. They've had a bad year. I'm not sure what's going to happen in the future. The trend doesn't look great. So I'm going to give that sort of a neutral rating. And looking at profit margin, this does seem to be moving generally in the right direction, going from 11% here to as high as 13.5% here, but it's lower. I'll give this sort of a neutral rating. Time will tell. And then looking at historic valuation, we shared how high that number is, but historically it does trade at a modest discount over the last 10 years. Or kind of in line. So I'm going to just give that a so-so. I'd like to see for it to be lower. With expenses seemingly flat, so that would actually be a thumbs up, but a very mature company, a company, slowing and in decline. But we do see here, we have insiders who've recently bought $200,000 worth of shares. That person might feel that we're near the bottom. So one to keep in mind, but I'll ask you to like the video, subscribe to the channel as we go over to analyze our second to last stock, which is Molson Coors. So TAP, they own Coors and Miller here in the United States. They also own Carling in the UK, as well as Molson in Canada. So some really nice brands. It's down 46.3% in about the last 7-8 years. So this has not been a great time to own the stock if you've had it for 7 or 8 years. Let's look over a 10-year time period to see if this has historically been a pretty good investment. Pretty flat actually for 10 years. So if we just zoom in on this a little bit, we can see in the last 5 years that it may have bottomed out and it's wanting to move higher. So we can see the stock up 80% in just about the last 3.5 years. So I think that it's fair to call this stock a great stock or a good stock. And I do like the way that this price chart is looking. So let's get under the hood, take a look at TAP stock here on Qualtrim. We're going to run through this quickly. Forward PE of 11.7, that's cheap. Massive free cash flow yield of 10.9. Dividends at 3% at a really safe rate of only 33%. So I'm excited about the dividend on this stock. Let's take a look at the top line revenue. Over the last 10 years is good, 10.7, but slowing in the last 5, 1.8. So this stock is really going to be all about its dividend. I'm going to give this a so-so rating. Let's get in here and take a look at that free cash flow. I'm liking the way that this chart looks. There's been some ups and downs. They had like a hacking incident, among other things, obviously the pandemic and restaurants and public venues shutting, but they're showing a nice recovery, showing a really nice recovery through here. So looking at the totality of this, I'm going to give it a thumbs up for free cash flow, growing about 4.8% a year over the last 10. Looking at earnings per share, it's been lower in the last 5, but up about 4% over the last 10. Inconsistent and not very high growth, so a medium rating on EPS. Cash and debt. So they've paid back a lot of debt while holding cash about steady. They're not having a hard time meeting their dividend, and they're paying the debt off steadily. So I'm going to give this a very small thumbs up, but that's something to watch out for right there. Let's see if they've ever cut dividends before. They have here and back here. That was so long ago, and this was COVID related. I'm not going to judge this company, but its dividends are growing at only 1.4% a year. So this is a high starting yield without a lot of growth in front of it necessarily, although they've had a jump in the last 2 years. I'm going to give this sort of a so-so rating. You're really buying the stock just for its current yield. Shares outstanding, they're flat over 5 years, but over 10 years, they've gone up. I'm going to give this a thumbs down. Looking at ratios, returns on capital employed, flat-ish, right around this 8% range since forever. I'm going to give this, I'm going to give it a thumbs down. Under 10% isn't great, and the trend also isn't great. So their pricing power is called into question. Looking at profit margin, they're holding it around 8, 9, 10%. There's been some inconsistencies. The bottom line profit margin's okay. I'm going to give it somewhere between a neutral to a thumbs down. Now, looking at valuation over the last 5, it's sort of in a middle range. I'll give it a middle rating, and expenses are going up, so that's a thumbs down. So, so far what I'd say is I feel best about Target, and I think I like the looks of Starbucks as well as Target, Estee Lauder, and Tap. Estee Lauder is the worst that we've looked at so far. Tap I like, pretty defensive, pretty good starting yield. So let's finish by looking at Dollar General, down 47.4%, and that's just here in about the last year and a half, 2 years. So we want to know if we've reached the bottom. We want to know if this is a great stock. So over the last 10 years, the stock has returned how much? Turned about, over the last 10 year, about 150%. So something like 11, 12% a year. That's quite good returns. And that had been much higher until recently. So we have this steep drop off in price, down about 48%. But this can certainly be referred to as a great stock. And so we want to take a look at it over here on Qualtrum. Forward PE of about 20.6. It's a little bit high. Respectable free cash flow yield of 2.1%. We have a nice dividend, 1.72, a bit higher than the market at a really sustainable payout ratio. So we'd hope for dividend growth on this company. But let's see how top line growth is. Over the last 5 years, 8.6%, accelerating from the last 10. Big thumbs up. I'd love to see that growth there. Looking at free cash flow. This doesn't look good. take a look at it quarterly. So, these are going to be anomalous type numbers here, but what I'm seeing is um, they seem to be able to, they can be relied on to produce $200 million a quarter in free cash flow. And that was the case 10 years ago. Um, and they've had a nice jump from 10 years ago from that number to that number. So, 247 million 10 years ago, 479 today. I'll give it a thumbs up. But you sort of have to, be, a little bit diligent here in looking at those numbers, but the free cash flow looks fine to me. Looking at earnings per share, up 5%, 4.8% over the last 5, which is slowing down from the last 10. So I'll just give it a so-so rating. We're seeing some good things with top line revenue and with dividends. So those seem to be important things for this stock. They've had more debt in the past, but their levels of debt to cash seem questionable. Let's look on the quarterly basis. That might not be right. Historically, they've had a lot of leverage. If this number is an error, which I think that it might be, I'm going to give this a thumbs down. That the caveat would be if that number is correct and they've paid off all their debt, but I'm not sure if I believe that they paid off $1 billion or they paid off $5 billion of debt in a quarter. I don't think I believe that. Not sure. So anyway, historically they've got some good leverage on them. So not sure exactly how I feel about that. Dividends, great growth, 13%. 3, 4, 5xing inflation over the last 5 years. Big thumbs up. I don't see any dividend cuts coming from this company. That looks really good. A lot of dividend growth, I think, can be expected in the future. Do they dilute shareholders? No, they don't. Shares down 3.7% over the last 5 years per year. Really nice clip there. Big thumbs up. Looking at ratios, return on capital employed, less than 10% on a downward trajectory. I'll give it a thumbs down. I do love seeing that this profit margin seems to be expanding. 2014 was 5.9. It had gotten as high as 7.9. Now we're down lower, but it's at 4.3%. Again, that's going to be higher than Walmart, higher than Kroger's. It's flattish over 20 years. I'm going to give it sort of a so-so rating. Let's look at historical valuation. It's at a discount historically there. I'm going to give it a thumbs up. Lastly, with expenses rising, but they've just brought in their old CEO who was really well respected, this gentleman, and they're getting rid of self-checkout while bringing in more hard goods as well as fresh grocery. And this is the Walmart for towns of 10,000 people. So I think they have a little bit of a moat here. So what I'll say is this: out of the 5 that we looked at, I'm really liking the looks of Target as well as Starbucks. And then also I'm liking Dollar General. When it comes to TAP or core stock, I think the chart looks good and I think it has a nice high starting yield. It's defensive, but that's just about it. And looking at Estee Lauder, I can definitely see some of their fundamentals deteriorating. So not exactly sure where that's going to go in the long run, but that's it. Thanks so much for tuning in to Not Financial Advice. I'm Sean. See you on the next one.